Imagine you're running a restaurant.
Yeah.
And it is the hottest spot in town. Like every single night, there is a line wrapped around the block just to get in the door.
Right.
Everyone is taking photos. They're raving about your food online.
Mm-hmm.
The dining room looks like an absolute triumph. But, if you walk through the swinging doors into the back alley, you see your cooks frantically throwing out thousands of dollars of rotting ingredients.
Bizarre.
And worse, you're secretly begging the bank for a high-interest loan just to make your Friday payroll. So on the surface, you're a sensation. But behind the scenes, you're just bleeding out.
That is exactly the dynamic we are investigating today.
Because today's target for our deep dive is On Holding AG. And just to set the timeline for you listening, the date is Tuesday, April 28, 2026.
Mm-hmm.
If you've walked outside in the last few years, you know exactly who they are.
Oh, they're everywhere.
Right. This is the premium sportswear brand, famous for those running shoes with the distinctive kind of hollow pods on the soles, the Cloud Tech. They have been on marathon starting lines, corporate boardrooms, Zendaya campaigns, Roger Federer sponsorships.
Yeah, the marketing is ubiquitous.
The ticker symbol on the New York Stock Exchange is ONON. And looking at the latest data, we are talking about a company with a market capitalization of exactly $14.53 billion US dollars.
And before we dive into a single metric, we really need to establish the ground rules for you, the listener. Because On Holding is a Swiss company headquartered in Zurich, their official consolidated financial statements. So the annual report and the interim filings we are looking at today, they are all reported in Swiss francs.
Right, abbreviated as CHF.
Exactly. However, as just mentioned, their stock trades in the U.S. and their market cap is evaluated in USD. So to keep things crystal clear for you, for all financial comparisons today, we are using a strict conversion rate of 1.0000 Swiss francs to 0.80 US dollars. No exceptions.
That makes perfect sense.
Yeah.
Keep the currency math simple so we can really just focus on the actual business.
Exactly. And our mission today is to strip away the marketing fluff. I mean, forget the celebrity endorsements, forget the beautiful lifestyle branding, forget the giant billboard in Times Square.
We're looking at the actual engine.
We're going to examine the latest fiscal year 2025 annual report, which was dated December 31st, 2025, and officially authorized on March 3, 2026, alongside the Q3, Q2, and Q1 reports of 2025. We will compare these figures with ruthless precision to the fiscal year 2024 baseline.
I love it.
We are treating this as a strict clinical forensic audit. We have a 9-point structural checklist to get through, and we are not skipping a single step.
We are getting out the magnifying glass and acting as lead auditors today because, as a casual observer, the growth story here looks nothing short of phenomenal. I mean, it's hard not to get swept up in the hype when you see the retail stores so packed.
Oh, we will see if the numbers actually justify that hype. Moving to point one, the number drill down in profit margins.
Okay, let's unpack this and look at the top-line performance first. Fiscal year 2025 net sales hit roughly 3.63 billion Swiss francs. Applying our conversion rule, that translates to about 2.9 billion US dollars. That is a massive jump from the 2.63 billion Swiss francs they reported in 2024. I mean, a clean billion-franc jump in top-line revenue in a single 12-month period. You look at that kind of growth, and it's incredibly easy to see why retail investors have just fallen in love with this stock.
The top line is undeniably impressive. It shows they are moving serious volume.
And it gets better, or, well, at least it seems to. They're boasting a gross margin of roughly 62.92%. Now, for you listening, gross margin is basically what you have left after you pay for the raw materials and the factory labor to actually make the shoe.
The direct costs.
Right. Keeping almost 63 cents on the dollar after direct manufacturing costs for a physical apparel product is exceptional. It shows immense pricing power. People are willingly paying premium prices, sometimes upwards of $160 or $200 for these shoes. And then they pair that with an operating margin that's still at around 12.57%. On paper, if I'm just glancing at Yahoo Finance, this looks like a hyper-growth brand executing perfectly.
I have to stop you right there. That is exactly the kind of superficial cheerleading that gets everyday investors burned.
Ouch. Fair enough. But
You are reading the headlines, but you aren't reading the fine print.
okay, lead auditor, what am I missing?
I want to look past these heavily curated numbers. Management aggressively pushed certain quote-unquote adjusted EBITDA metrics in the Q3 and Q1 reports of 2025, really trying to draw your eye to that gross margin.
Yeah, that 63% is flashy.
It is. But let's look at what actually trickles down to the bottom line, the money the company actually gets to keep. The net margin is only 6.84%.
Wait, let me make sure I'm understanding that. From that massive 63% gross margin, they're only keeping less than 7% as actual net profit.
Exactly. And that should be a massive red flag for you, the listener. Why is a premium brand with a nearly 63% gross margin only taking 6.8% to the bottom line?
Where's the money going?
Where is the friction? Where is the money leaking out of the system? I'll tell you exactly where. Look at the massive selling, general, and administrative expenses, what we call SG&A in the accounting world.
Okay, let me pull that up.
For fiscal year 2025, SG&A totaled an astonishing 1.83 billion Swiss francs.
1.83 billion.
Over half of their total revenue is completely consumed by marketing, sponsorships, retail store build-outs, and administrative overhead.
But let me push back on that for a second. Isn't that just the reality of doing business in the highly competitive footwear sector?
Is it?
I mean, aren't high SG&A costs completely normal for a hyper-growth brand that is trying to scale globally? You're competing with Nike, with Adidas, with Hoka.
Yes, the competition is fierce.
Right, so you have to sponsor athletes like Zendaya. You have to open these massive, beautiful flagship stores in major cities like London and New York. You have to buy premium digital ad space. You have to spend money to make money, right?
What's fascinating here is that is the standard narrative, yes. But here's the clinical reality of what is actually happening. The entire bull case, the whole reason investors pay a massive premium for a high-growth consumer brand is based on the concept of economies of scale.
Right. Getting bigger makes you more efficient.
Let me explain exactly how economies of scale are supposed to work for the listener. The theory is that as your sales increase from 2.6 billion to 3.6 billion, your fixed costs, like your corporate headquarters, your core marketing team, your basic software infrastructure, those should become a smaller and smaller percentage of your total revenue.
Because you don't need a second CEO just because you sold twice as many shoes.
Exactly. Therefore, your operating margins should expand dramatically. You shouldn't have to double your marketing budget just to double your sales.
It's like if I buy a billboard in Times Square for $10,000 and it brings in 1,000 customers. If the brand gets more popular, maybe that same $10,000 billboard starts bringing in 2,000 customers. My cost per customer drops. I scale.
That is how a healthy business scales. But when you look at On Holding, their operating margins barely budged despite a 1 billion franc increase in sales.
Wow.
They aren't getting that billboard efficiency. To get that next 1,000 customers, they literally have to go buy a second and then a third billboard. If you have to spend an additional 1 billion francs in marketing and administrative costs just to generate an additional 1 billion francs in revenue, you aren't actually scaling.
You're just brute forcing it.
You are just running faster and faster on a treadmill. The core business engine is highly inefficient, and that 6.84% net margin is razor thin for a company commanding a $14.5 billion valuation.
Okay, that makes perfect sense.
Yeah.
They have this incredible high-performance engine, but they're burning so much fuel just to keep it running that they aren't actually generating any real horsepower for the shareholders.
Precisely. And the management team is acutely aware of this inefficiency, which brings us to how they attempt to present these numbers to the public to make them look better. Moving to point 2, one-off effects versus operative development.
Ugh. The classic accounting spin zone. So I found a very interesting line when I was digging into the fiscal year 2025 and cash flow statement. It explicitly notes a, quote, higher net income after adjustments of CHF 194.4 million, end quote.
Oh, I saw that.
Almost 200 million Swiss francs just lumped into an adjustments category to make the net income look higher.
It is an incredible amount of money, and this is where we need to act as forensic interrogators. What exactly constitutes these so-called adjustments? Because management teams love to use a metric called adjusted EBITDA to present a highly sanitized, highly optimistic version of their reality.
For you listening who might not live in spreadsheets every day, let's break down EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization.
A mouthful.
Yeah, and I've always heard it described jokingly by analysts as earnings before all the bad stuff happens.
That is a very accurate joke.
Oh.
EBITDA is basically a measure of cash profit from the pure daily operations before the taxman takes his cut, before the banks take their interest, and before the accountants factor in the aging of your equipment.
Which is fair enough. It has its place.
It has its uses. But adjusted EBITDA is where the real trickery happens. They take that basic profit number and start adding back expenses that they claim are one-time, exceptional, or non-operative.
Basically saying, hey, ignore this massive expense over here. It won't happen again, so judge us on the clean number.
Correct. But when we drill down into that 194.4 million franc adjustment, we find a glaring issue that is anything but a one-time event. Exactly 66.6 million Swiss francs of that adjustment in fiscal year 2025 is share-based compensation.
Share-based compensation. So we're talking about stock options, restricted stock units, equity grants given to the executives and the employees instead of cash bonuses.
Exactly. Management aggressively wants you, the listener, to ignore the 66.6 million expense. They argue that because it is a non-cash expense, meaning they didn't have to physically wire money from the corporate bank account to the employees, it shouldn't count against their operative performance.
Yeah.
But I want to be perfectly clear about this. Is compensating your workforce a non-operative expense? Absolutely not. Paying your employees is the most fundamental operative expense a business has.
So why is it so bad if it didn't cost them cash today? I mean, a lot of tech companies do this to save cash.
Because while it doesn't drain the cash balance today, it directly and permanently dilutes you, the shareholder.
Let's visualize that.
Imagine you own a pizza, cut into 10 slices. You own one slice, you own 10% of the pizza. Share-based compensation is the company deciding to cut that same pizza into 20 slices to give some to the employees. The overall pizza didn't get any bigger, but your slice just got cut in half. It increases the total share count, which means your ownership of the company's future profits gets smaller. Adding that 66.6 million back into the profit column to create a bloated adjusted figure is a purely cosmetic accounting illusion designed to flatter management's performance.
That is brutal.
Yep.
So they are essentially paying their staff in equity, telling investors not to worry about it because it didn't hit the cash balance. But in reality, the retail investors are the ones footing the bill through the dilution of their shares.
That is exactly what is happening, and the creative accounting gets even deeper. I want to point out a very subtle but critical accounting change noted deep in the footnotes of these reports.
Oh, I love footnotes. What did you find?
Beginning in Q1 of 2026, On Holding has decided they will start recording currency translation adjustments in a category called Other Comprehensive Income rather than on the main income statement.
Other comprehensive income, or OCI. Let's translate that for the listener. I've always thought of OCI as the rug that corporate accountants use to sweep away the financial dust they don't want visible on the main floor.
That is a brilliant way to conceptualize it. Let's look at the mechanics of why a Swiss company would do this. On Holding is headquartered in Zurich, so they report in Swiss francs.
Which we discussed.
Right. But they manufacture predominantly in Asia, paying in US dollars or local currencies, and they generate massive sales in North America and Europe, collecting US dollars and euros.
So say they are a global company, constantly dealing with exchange rates.
Yes. And because of this, they are highly exposed to foreign exchange fluctuations. Historically, if the US dollar weakened significantly against the Swiss franc, it would show up as a painful hit to their main income statement. Everyone looking at the headline earnings per share would see the drop.
It's front and center.
But by moving these currency translation adjustments to the other comprehensive income section, which bypasses the main income statement and goes straight to the equity section of the balance sheet, they are employing a classic maneuver to smooth out earnings volatility.
So for you listening, just know this. When the US dollar drops, On Holding loses money on the conversion. But instead of showing you that loss on the front page of their report card, they've decided to start hiding it in the footnotes on page 40.
Exactly. They are trying to hide the operational inefficiencies and real financial impacts caused by foreign exchange mismatches. It makes the headline earnings per share look much more stable than the underlying volatile reality of the business actually is.
Okay, so if we strip away the $66.6 million in share-based compensation that they want us to ignore, and we factor in the reality of their massive $1.8 billion in SG&A bloat, what does that actually do to their true operative profit?
It absolutely crushes it. If we refuse to accept these generous adjustments, the true operative profit, the actual cash-generating capability of the core business of selling physical shoes, is far, far less profitable than the headline adjusted EBITDA suggests.
Wow.
You are looking at a company that is fighting tooth and nail, spending billions on marketing just to maintain a mid-single-digit net margin, all while pretending to be a highly profitable, tech-like apparel company.
That drastically changes the narrative.
Yeah.
It moves them from being a high-margin compounding machine to a capital-intensive marketing company that just happens to sell shoes.
Which leads us perfectly into examining what this company actually owns and owes. Moving to point 3, the balance sheet quality and debt check.
All right, let's pull up the balance sheet. Now, if I am a casual investor and I just glance at the top-level liquidity ratios, I would think On Holding was a financial fortress.
How so?
Well, the current ratio looks very safe at 2.71. For those listening, the current ratio is just your short-term assets divided by your short-term liabilities. It means they have $2.71 in short-term assets for every $1 they owe in the next 12 months.
Right.
And their debt-to-equity ratio is very low at 0.36. Conventional wisdom says this is a rock-solid, conservatively financed company. I don't see the crisis here.
That is exactly why we conduct forensic audits. A surface-level reading is completely misleading. I want you to look deeper at the footnotes regarding their credit facilities.
Okay.
A current ratio of 2.71 is completely meaningless if the assets making up that 2.71 are toxic or illiquid.
Let me pull up the footnotes regarding the credit facility. Let's see here. Oh, wow. The pledged inventory. I see what you were looking at.
Yes, look at the inventory explosion. This isn't just inventory sitting in a warehouse. This is inventory that On Holding has explicitly pledged as collateral to their banks to secure their credit lines.
Pledged as collateral.
That pledged inventory skyrocketed from 211.7 million Swiss francs in 2024 to an astounding 340.4 million Swiss francs in 2025.
That is a massive jump.
And total pledged assets, which also includes trade receivables money owed to them by retailers, reached 606.9 million Swiss francs.
Hold on. So they are borrowing money and using their massive warehouse full of unsold running shoes as the literal collateral to secure those loans.
That is exactly what they're doing. And this raises a critical, fundamental question for you, the listener. If sales are so phenomenal, if the brand is as red hot as that 3.6 billion top-line revenue suggests, why is the company holding and borrowing against a massively inflating stockpile of unsold shoes?
That doesn't make sense. If demand is so high, the shelves should be empty.
Exactly. This introduces a very dark hypothesis in the world of forensic accounting. It's called channel stuffing.
Channel stuffing. Okay, let's explain the mechanics of that. That's when a brand aggressively pushes inventory out to its wholesale partners, like Foot Locker, Dick's Sporting Goods, or REI, to recognize the revenue immediately, even if consumer demand on the street hasn't caught up right.
Precisely. Let's walk through the exact mechanics of how channel stuffing happens. Imagine you are the sales director at On Holding.
Okay, I'm a sales director.
It's the end of the quarter. You need to hit your aggressive revenue targets to please Wall Street. So you call up the buyer at a major retail chain. Normally, they might order 10,000 pairs of shoes and pay you in 30 days.
Standard order.
But to get them to take 50,000 pairs right now, before the quarter ends, you offer them extended 90-day payment terms. You offer them slight discounts. You do whatever it takes to get that product off your loading dock and onto the wholesaler's books.
Because the moment the truck leaves your dock, under standard accounting rules, you get to book that as a sale and report it as part of your $3.6 billion in revenue.
Exactly. The income statement looks fantastic.
Right.
But if the end consumer, the person actually walking into the store, isn't buying them at that same accelerated velocity, that inventory backs up. The retailer's back room gets completely full.
So the product isn't actually moving off the shelf.
Right. The fact that On Holding's pledged inventory jumped by over 128 million francs in a single year strongly suggests they are manufacturing and shipping products significantly faster than it is actually selling through to the street.
Let me bring back that analogy from the beginning of the deep dive.
Yeah.
It's like that popular restaurant claiming they're fully booked and doing record revenues. But when you look in the back, the kitchen is overflowing with rotting ingredients they bought on credit.
Mm-hmm.
They look successful in the dining room, but the back-of-house operations suggest a looming crisis.
That is the perfect analogy. The dining room is the income statement. Everyone sees the revenue. The kitchen is the balance sheet. That's where the rot accumulates. And the balance sheet is telling us that the $3.6 billion in sales might be an illusion of timing.
Smoke and mirrors.
They might be pulling future sales forward into the current quarter. Which naturally brings us to the ultimate truth teller in any business. You can massage the income statement, you can shuffle the balance sheet, but you cannot fake cash. Moving to point 4, the cash flow analysis.
The cash flow statement. This is where accounting illusions go to die. Let me read the raw numbers directly from the 2025 report.
Please do.
Cash inflow from operating activities for the 12-month period ended December 31st, 2025, decreased by 151.1 million Swiss francs, down to 359.5 million. That is down from 510.6 million in 2024. Wait, I must be reading this wrong. Revenue went up by 1 billion francs, but the actual cash flow from operations dropped by 150 million.
You are reading it perfectly. It is a cash flow collapse.
Right.
And I want to get highly clinical with these numbers for the listener because this is the smoking gun. We need to look at the exact free cash flow yield.
Okay, let's do the math.
Based on the market data we extracted from the March 2026 pricing, the stock is trading at a price-to-free cash flow ratio of 35.32. If we invert that ratio mathematically, I can explicitly state that the free cash flow yield for on-holding is exactly 2.83%.
Let's pause on that. A 2.83% yield.
Yes. For a mature, supposedly hyper-growth company valued at over $14.5 billion US dollars, a 2.83% free cash flow yield is incredibly weak.
To put that in perspective for the listener, you could buy a risk-free U.S. Treasury bond right now, backed by the United States government, and get a higher cash yield than you are getting from taking on the massive risk of holding equity and on-holding.
Precisely. The business is generating a massive amount of paper revenue, but an anemic, almost negligible amount of actual distributable cash.
And how does that cash generation relate back to the net income they reported on the income statement? How do we measure the disconnect between the fantasy and the reality?
We measure it by calculating the exact accruals ratio. We look at the balance sheet cash flow accruals, which is simply a formula, net income minus operating cash flow. With the reported net income sitting at around 248.65 million Swiss francs and operating cash flow at 359.5 million, the absolute accrual is negative 110.85 million Swiss francs.
Okay, let me play student here. Net income minus operating cash flow gives us a negative 110.85 million. Now, normally when operating cash flow is higher than net income, meaning you have a negative absolute accrual, that's considered a good thing, right?
Generally, yes.
It implies that the reported earnings are backed by real cash, maybe even understated.
Theoretically, a negative accrual is healthy. While cash flow is technically still higher than net income, meaning the absolute accrual is negative, my clinical analysis shows that the gap between those two numbers is shrinking at an alarming rate compared to 2024.
Oh, I see.
Remember, operating cash flow fell by 151.1 million year over year. Earnings are growing steadily on the income statement, but the actual cash generating those earnings is vanishing.
Converging in the wrong direction.
The quality of the earnings is deteriorating rapidly. You are seeing profit on paper, but you are not seeing it deposit into the bank account.
That is a terrifying trend line. So the profits are basically trapped. But where are they trapped? If the money isn't in the bank, what form is it taking?
Moving to point 5, working capital management. That will show us exactly where the cash is bleeding out.
Okay, looking at the cash flow statement under working capital, the main driver of that cash flow collapse is glaringly obvious. There's a negative 233.8 million Swiss franc swing in working capital.
Nearly $250 million.
And the management report explicitly states this is primarily due to, quote, changes in inventories and trade receivables.
Let's translate that working capital swing into reality for the listener. Working capital is essentially the cash tied up in the day-to-day operations of the business. It's the grease in the gears.
Right.
When trade receivables go up significantly, it means customers. The big wholesalers like Foot Locker on holding more money, but they haven't actually paid yet. They're stretching their payment terms.
And when inventory goes up?
When inventory goes up, it means cash has been converted into physical goods that are just sitting there. Cash is sitting in massive warehouses in the form of unsold running shoes.
Literally piles of rubber and foam.
A 250 million franc negative swing in working capital means the company is literally hemorrhaging cash to fund its own unchecked growth. We look at a metric called Days Inventory Outstanding, or DIO. Their DIO is expanding. They are manufacturing shoes significantly faster than consumers are buying them.
Okay, I'm going to try and play devil's advocate here just to test the thesis. It's late 2025 in this report. Couldn't this massive buildup in inventory just be normal, prudent preparation for the spring 2026 running season?
That's the common defense.
They know the weather's going to warm up, marathon training starts, demand is coming, so they are proactively stocking up. Isn't that just good supply chain management?
I am going to shut that down completely.
Wow, okay, why?
A negative $250 million swing in working capital is a structural failure in inventory management, not a seasonal quirk. If it were purely seasonal, we would have seen a similar proportional swing in late 2024 as they prepared for the spring of 2025.
Oh, that's a great point.
But we didn't. This is a dramatic, unprecedented escalation. It is tying up capital that should be returning to you, the listener, as a shareholder.
Instead of a dividend.
Exactly. Instead of generating free cash flow that could be used for dividends or share buybacks, they are using their cash to build mountains of inventory, which they then have to pledge to the bank just to maintain their credit lines so they don't default. It is a vicious cycle of capital destruction.
That is a brutal, unvarnished assessment. Which naturally brings up the question of what the executive management is actually doing with the limited cash they do have.
Let's examine exactly that. Moving to point 6, capital allocation and ROI.
Where is the cash going? Well, if we look at how the company rewards shareholders directly, the dividend payout is exactly 0.00%. They are not returning a single franc of cash to the people who actually own the company.
Let's clinically dissect the equity statement to see how they are managing the share count in the absence of a dividend.
Okay.
While the company made a token, almost insulting purchase of treasury shares totaling a mere 0.2 million Swiss francs, basically a rounding error, they simultaneously handed out 66.6 million Swiss francs in share-based compensation to themselves and their employees.
So they bought back 200 grand, but gave out 66 million.
They are diluting shareholders at a rate hundreds of times faster than they are buying back stock.
So they aren't paying a dividend, and they are aggressively printing new shares to pay themselves, which shrinks the listener's ownership stake. But what about the return on the capital they are actually investing back into the business?
Let's look at it.
The return on invested capital, or ROIC, is listed at 9.49%. Now, for a layman, a near 10% return on investment doesn't sound terrible on the surface.
It doesn't sound terrible until you compare it to their weighted average cost of capital, or WACC. Let's explain this concept. WACC is basically the minimum return a company needs to earn just to satisfy its investors and its lenders.
Their hurdle rate.
Exactly. We are operating in a macroeconomic environment where interest rates are significantly elevated. When you factor in the high-risk premium demanded by investors for a consumer discretionary apparel brand, which is a sector notoriously vulnerable to changing fashion trends and sudden consumer spending pullbacks, their cost of capital is high.
Because if a trend fades, the apparel company tanks.
Mm-hmm.
So investors demand a higher return to take that risk.
Precisely. A 9.49% ROIC barely clears that hurdle. They are effectively treading water.
Meaning for every dollar they invest back into the business, whether that's a new store lease or a new ad campaign, they are barely generating enough return to pay for the cost of acquiring that dollar in the first place.
My conclusion on their capital allocation is uncompromising. Capital is being deeply misallocated. It is being plowed into stagnant inventory and excessive executive equity compensation, rather than generating real, compounding shareholder returns. The engine is running incredibly hot, but the car is barely moving forward.
Okay, so if the financials are this strained beneath the surface, if the cash flow is collapsing and the inventory is piling up, you have to look at the people steering the ship. Who is accountable? And here's where it gets really interesting.
Moving to point 7, corporate governance and management incentives.
There has been a massive leadership shakeup announced right in the middle of this financial reality. They are bringing in a new CFO, Frank Sluis, who is taking over in May 2026, and they're also transitioning to a co-CEO structure.
A major red flag.
Right. When a high-growth company suddenly changes its chief financial officer right as operating cash flow starts to collapse, warning bells have to go off.
The warning bells should be absolutely deafening. I want to read you the devastating list of insider sales. While management was publicly projecting confidence, touting $3.6 billion in sales and pumping the stock to retail investors, look at what they were doing with their own personal money.
This is the part that really shocked me.
Executives Mark Maurer, Martin Hoffman, David Alleman, Olivier Bernhardt, and Casper Coppetti. This is the entire core leadership and founding team proposed selling millions of dollars worth of stock between late 2025 and March 2026.
And look at the prices. They were filing to sell massive blocks of shares at prices ranging from $42 to $60 a share.
Yes.
And right now, as we record this on April 28th, 2026, the stock has tumbled down to the $35 range.
They timed the top flawlessly. And it gets even more concerning when you look at corporate policy. On Holding instituted a financial statement compensation recoupment policy, a clawback policy, in March 2024.
What does that mean for them?
This policy allows the board to claw back executive bonuses if the financial statements ever have to be restated due to material noncompliance.
Wait, really? So if the numbers are fake, the board can take the cash back?
Exactly. I want you to ask yourself, why does the entire founding and executive team cash out tens of millions of dollars right at the peak, just as operating cash flow collapses, inventory balloons to a $250 million franc deficit, and a new CFO is suddenly brought in to take the wheel?
You're suggesting they saw the writing on the wall. They looked at the internal dashboards. They knew the inventory was backing up in the warehouses. They knew the cash conversion cycle was failing. So they liquidated their personal holdings to lock in their wealth before the market caught on.
And then handed the messy balance sheet to Frank Sluis to clean up.
Wow.
I am simply presenting the timeline of facts to the listener. The optics are horrifying for a retail investor who bought the hype and is now left holding the bag at $35 a share.
A heavy bag, too.
And those retail investors are holding a company that is also facing massive external threats that aren't fully reflected in the numbers yet. Moving to point 8, off-balance sheet risks.
Okay, off-balance sheet risks. If we look at the standard disclosures in the annual report, there is a notable lack of massive pending litigation mentioned. So legally, from a lawsuit perspective, they seem relatively unencumbered.
That is a very myopic view. The real off-balance sheet risk for On Holding doesn't lie in a courtroom. It lies in the macroeconomic and global tariff environment.
Tariffs, right.
Let me reference some recent market news that you might have seen. There was a recent Supreme Court ruling striking down certain import tariffs, which caused a brief euphoric pop in footwear stocks, including On Holding.
Yeah, everybody thought it was going to be cheaper to import goods.
But that is temporary noise. On Holding has a heavy, almost total reliance on international supply chains. They manufacture predominantly in Asia, yet they generate massive sales in North America and Europe. They're uniquely vulnerable to geopolitical friction, freight cost spikes, and trade disputes.
And what about their physical footprint? We talked earlier about how part of their SG&A spend is opening these massive, beautiful flagship stores.
Yes, the leases and commitments. This is a massive hidden anchor. To support that 3.6 billion franc sales volume, they have entered into long-term operational lease commitments for high-end retail physical stores globally.
And those aren't cheap.
Not at all. And they also have massive leases for the giant warehouses needed to house that 340 million francs in pledged inventory. These leases are inflexible, long-term liabilities.
So if things go south, they're stuck.
If consumer demand wanes, if the hollow pod shoe trend suddenly goes out of fashion and consumers move on to the next big thing, On Holding cannot easily exit those leases. They are locked in.
It's like signing a 10-year lease on a giant mansion right before you lose your job.
Exactly. It represents a massive off-balance sheet liability that will drag down earnings for years if the top-line growth ever stalls.
So we've systematically torn apart the income statement, the balance sheet, the cash flow, the governance structure, and the macro risks. We started at the front door of the restaurant. We walked all the way out to the dumpster in the back alley. It's time to bring it all together.
Moving to point 9, the forensic overall judgment.
Let me summarize the bull case one last time, just to be fair to the optimists out there. If you just look at the billboard, On Holding has phenomenal top-line growth. They grew sales by a clean billion francs in a single year.
True.
The brand is ubiquitous. You see the shoes on everyone, from nurses to bankers. They have a massive 63% gross margin, indicating real pricing power. To a casual observer, this is a triumphant, undeniable success story.
And here is the final clinical judgment of the forensic auditor. The quality of On Holding's earnings is deeply suspect.
Deeply suspect.
The operative development is absolutely not sustainable. The headline net income is being propped up by non-cash adjustments like massive share-based compensation, masking the fact that the true operating margin is razor thin. More importantly, the actual operating cash flow is being devoured by a bloated, pledged inventory. They're literally borrowing money to build shoes they haven't sold yet. The balance sheet is essentially becoming a heavily leveraged warehouse of unsold inventory.
It's a beautiful facade of profitability built on aggressive accounting, channel stuffing, and inventory stockpiling.
Exactly. I will leave you, the listener, with this final provocative question to ponder long after this deep dive ends. When the architects of a company's hyper-growth phase aggressively liquidate tens of millions of dollars of their own shares while simultaneously passing the financial steering wheel to a brand new CFO amidst a collapsing cash flow,
Yeah.
are they simply securing their well-deserved wealth? Or are they fleeing a burning building before the smoke becomes visible from the street?
Man, that is a chilling thought to end on, but it is exactly why we do this. Thank you to everyone listening for joining us on this rigorous forensic journey through On Holdings financials. Take these insights into your own portfolio analysis.
Look at the cash.
Remember, glossy marketing brochures and A-list celebrity endorsements are designed to sell shoes. But true financial health is only found deep within the footnotes of the cash flow statement. Stay curious, stay critical, and we will see you on the next deep dive.